there are so many cross currents now. Pre-COVID, you could sit there and say, hey, globalization is a thing. The world's pretty peaceful. Prices are going to go up. Low rates are here for forever. And whilst you can't say with absolute certainty how this is going to go, in 2018, the number of potentially bad outcomes was small. In 2024, the number of potentially bad outcomes is very big. And because of that, and the damage that a bad outcome and a significant drawdown in your portfolio can have, means it's much more important to pay attention now and have a plan than it was in 2018.
Grant Williams, author of the newsletter Things That Make You Go, and host of the Grant Williams podcast. It is so great to welcome you back on the show. Great to see you again. It has been almost a year and far too long since we last had you. So thank you so much for taking the time, Grant.
Oh, it's always a pleasure. Has it really been a year? It doesn't seem like that. Jeez.
December of last year. And
wow.
I got to say, okay, I don't want to go that long ever again. And I know you're a busy man, but maybe we should do a bit more of a frequent check-in with you.
Anytime, Julia, anytime. You know
okay,
that.
Well, I got to say, I loved our conversation last year, and that was probably one of my favorites.
Come on,
a lot of favorites, but no,
I've
it definitely
seen your
was.
show. You've had so many great guests on.
Yeah, but I really liked our conversation because I also felt like there are a lot of great lessons along the way. And as you know, Grant, we always start with that big picture, that macro view, and lots happened in the last 11 months. So let's start there with the big picture, the macro view, where we are today, the framework in which you're looking at the world, the economy, markets. And as you know, Grant, if you watch the show, you can take all the time you need to set the table.
Well, thank you. Confusion, I think, is the word that just leaps to mind. And look, it's always confusing. And I've spoken about this a lot, but we are all essentially trying to forecast the future, which is completely unknowable. So it's always clouded in possibilities and probabilities, and we always have to try and figure out a way to handicap those to the best we can. But right now, there are so many different threads that are pulling at this thing from all directions that make it even more difficult to figure out how to try and set yourself up in a way that really, at this point, instead of giving yourself the most chance to make big gains, it's a kind of hunker down. Let's figure out how not to make any mistakes. That given any one of these things, whether it's the war in Ukraine, the proxy war in the Middle East, the US election, the UK budget, there are so many things now which could cause us a severe drawdown if we get it wrong. That I think it's never been more important to just accept the fact that we really don't know what's going to happen. We don't know what's going to happen next Tuesday, or in Tuesday in 2 weeks' time. Sorry, in the US, we have no idea, and everybody's calling this an existential election. Everyone's talking about how meaningful it is and the dire consequences should either side win, and people kind of buy into that. If you look over the long term, if you look at the stock market's performance and you split it into Republican and Democrat administrations, you'll see the market generally just kind of goes bottom left to top right. Inflation will take care of that anyway, but the market tends to go bottom left to top right. And you get these drawdowns and big events every now and again, but they're pretty agnostic as to which kind of administration they occur in. So the data suggests that it doesn't really matter who wins the election. And I think this time around, as crazy as it seems, it probably matters even less because both parties, whichever one wins ultimately, are going to be forced down the same road, which is monetization ultimately, because the numbers no longer add up. The debt has reached a point now where it's completely unmanageable, and the cost of servicing that debt is becoming increasingly onerous, and that's leaving whichever party wins decisions to make around where to cut spending, because they have to pay the interest on the debt. They've got they're not going to cut defense spending, obviously, given what's going on in the world. They can't cut entitlements. So we're going to be in a situation where either side is going to be forced to go into greater debt, to have bigger deficits, to try and finance them. And that's ultimately, I think, going to lead to monetization. So if you take that as the potential outcome, then you realize that the problem you have really is debasement and protection of purchasing power. And that's what I think is one of the things that you've seen precious metals sniffing out recently, for example. You've seen a very extraordinarily strong performance from gold, which has got a lot of people kind of scratching their heads and not and trying to kind of find rationalizations for why gold would be going up when the dollar's rising, why gold would be going up when the stock market's rising. All these things that seem counterintuitive, if you look at it through a slightly different lens, actually make perfect sense. And I think coming back to the politics side of things, I was recently in California talking to a group of people there, and I made the point to them that the US, if you're watching this in the US, you're not alone. I mean, it feels like it. Wherever you are in the world outside the US, you get served US political news because it's that important. So if you're in the US, in the UK, Australia, Canada, New Zealand, all these kind of Germany, France, right across Europe, you get fed a steady stream of what's happening in the US elections. In the US, not so much. I mean, the US doesn't really get served the UK political stuff. You don't really know what's going on in France and Germany and Australia. And it's the same. It's the same divisiveness. It's the same existential crisis. It's the same debt problems. The whole Western liberal order has put itself in the same position. So I think it's important for Americans to know that you're not alone in this. We're all going through it to different degrees. But the problems that I've just described facing whoever wins the US election are present just about everywhere in the Western world. And so we've got this time where you've got that common problem in the West. You've got the Eastern bloc of nations. You've got the Russia, China, the BRICS, essentially the BRICS, trying to find a way out from under the yoke of the US dollar. And, it's happening at the margin. It's happening here and there. We just had the BRICS summit in Kazan this week. And there was an awful lot of pictures of Putin holding a fake note of what the unit of currency might look like for a BRICS. And, depending on your view of this whole thing, people are either laughing at that or saying this is the beginning of the end. It doesn't really matter. What's important is the direction of travel and the motivations behind it. So the BRICS countries are absolutely motivated to form some kind of unit, to form some kind of trading bloc that allows them to not be beholden to the US's whims around the SWIFT system, around the use of the dollar. And this is really their moment to do it. There's a reason this is all happening now, and it's starting to be a lot more visible, is that the situation in the West is such that because of the things we talked about, there is, I won't say weak, but they're as prone as they have been at any point since post-World War II and the establishment of the Bretton Woods system. They're as prone as they've ever been to not being able to necessarily fight the way they would need to keep this order together that has served them so well for that time. So that to me is the big macro picture. It's one of division. It's one of confusion. It's one of forces pulling apart rather than pushing together. The globalization has gone into reverse. And it really resets the way that investors have to think about the threats they face, the opportunities that may or may not be there, and the way they will set themselves up to deal with this. And for me, it's a mindset of, okay, how do I avoid getting caught up in this? What's the best way to deal with inflation rather than deflation? What's the best way to deal with rates that are prone to going higher rather than lower? What's the way to deal with the chance that a lot of governments are going to be forced to devalue the purchasing power of my savings? How do I mitigate that before I work out, which tech stock I should buy and which, AI company I should invest in? It's time to think about potentially negative outcomes and handicap what kind of damage they would do to you. Maybe you're set up and you don't care and you don't think they're going to be a problem, in which case carry on. But at least, and I hammer on this all the time because I think it's so important, take the time to assess the situation as in as unbiased a fashion as you can without looking at it through the lens of your investments, and then sit down and look at the way you're set up and say, can I be hurt?
Mm-hmm. That is such a good point, Grant. And it reminds me a little bit of our conversation last time. And I think it was the 1987 crash. You were in Japan on the trading floor. And that moment, it kind of upended your worldview. And you and I were talking last time about how kind of the environments you come up in, it shapes your worldview or your perspective as an investor. Like a lot of, look at the millennials, for example, we came out of crisis, but been pretty easy making money on the way up on in the stock market, or maybe you feel really smart or whatever. But, having to kind of step back and, kind of question or rethink or reset, as you put it, how you think about these things. I would love to just explore that notion further. And I'm apologize if I put any words in your mouth in that, but I kind of recall that from the last time. So just kind of understanding the frameworks that investors develop based on, maybe more recent events or the world that they're kind of coming up in.
Well, let's start with the millennials and the Gen Zs, and we did talk about this last time, and I think it's something that does bear discussion again because it is so important. If you look at millennials and look at Gen Z investors, they've been herded into passive vehicles as they've grown up in their investment lifetimes. They've been herded more and more into passive vehicles. They've been herded more and more into tech. They've been herded more and more into meme stocks. They've been herded into all these places. But the most important of those is passive. And it's the most important because the passive flows, as our mutual friend Mike Green has demonstrated superbly well, have really dictated the way the stock market has gone. And they've provided this engine, this underpinning that is relentless, and it has driven shares higher. And so if you think about what that does to your mindset when you're an investor, you find yourself thinking, right, well, I put my 401k goes into passive, and that just keeps chugging along and going up in the background, and hopefully it offsets inflation, and hopefully it helps me save for an unaffordable house and things like this. But then here I'm going to dabble in crypto, and I'm going to dabble in meme stocks, and I'm going to dabble in this, and so you've got this weird dichotomy between this kind of gambling aesthetic that has been very actively promoted to investors over the last sort of 5 or 6 years, and this boring, passive, put it in there and let it accumulate. And the two kind of sit fairly uneasily with each other. I think, I've written about this and I've talked about this in this past year about the difference between investors and speculators and the importance for all of us to understand who we are, because it's really difficult to be both. There are a few people who've done it spectacularly well and been incredibly successful. But generally speaking, if you're an investor, speculation can be very, very tricky because it really needs you to kind of disavow the bedrock principles of what it takes to be an investor. And vice versa. If you're a speculator who thinks he's an investor, it can be incredibly chaotic because you will do the wrong thing at every crucial point, more or less. So understanding who you are, first and foremost, taking a long, hard look in the mirror and saying, look, am I an investor? Am I a speculator? And, as I said when I wrote about it, it sounds so much better to be an investor. Everybody calls themselves investors. And I showed a slide when I presented about this of the recent meme stock, it's not recent now, but back in May, we had this meme stock resurgence when Roaring Kitty woke up and put that thing, and AMC went up, and GameStop went up. We saw this craziness. And all the headlines that I pulled out from Bloomberg and CNBC and Yahoo Finance and all these various places, they all said, retail investors flock to this. Retail investor do this. There wasn't one retail investor buying GameStop. There wasn't one retail investor buying AMC. None of them. They were all speculators, and that's totally fine. But this idea that is investing, if it takes hold, can be really problematic to shift, particularly when the world around you shifts. And I think that's where we are now. I think the world around us has shifted. I think it shifted a couple of years ago when rates started going up. And I think because we haven't seen the fallout that could possibly lead to, we're kind of in the reverse situation that we were in after 2008, when they started QE and they started printing money and everybody said, oh, it's going to be crazy inflation. And it didn't happen. It happened in asset prices because that's where the money was channeled. But the inflation that everybody was talking about was CPI inflation. And because that didn't happen, people kind of took their eye off the ball and assumed that, well, that was nonsense. We're not going to see inflation. Meanwhile, it was kind of building up in the system, and it took COVID and, more importantly, the stimulus response to COVID to finally kind of unleash that, because the money went to places where it would feed directly through into CPI inflation. We saw that in spades. Now it's the other way around. Rates have started to rise, and everyone said, "Oh, we're going to get crashing bond yields. We're going to see markets falling. We're going to see all these things that happen when rates go up," and it hasn't really happened yet. We've seen signs of what it'll look like, but we haven't really seen it play out the way a lot of people have talked about. So there's this kind of feeling the Fed have started to cut rates. Mission accomplished. Hang the banners. Everything is okay. We can all kind of go back to how things were. And I just don't think that works. I think inflation is embedded in the system now. I think inflation it's not dormant. And there was a fantastic piece from Kevin Walsh yesterday. I don't know if you saw that on CNBC, where he talked. I saw
this segment, yeah.
Yeah. And what he was saying was absolutely true. That, they keep moving the goalposts. They keep measuring inflation in different ways to try and sell this narrative that inflation is under control. And it might optically look like it is, but we've seen the price pressures building in the UK, for example. The new Starmer government, the first course of business was to award a 20+% pay rise to striking train drivers. And that's the kind of stuff that just gets embedded. And we've seen other, junior doctors go on strike, and we've seen other groups. We've seen the port workers in the US now starting to take serious industrial action to try and secure bigger pay increases for themselves. So this inflation is there. And we haven't had to deal with inflation for 40 odd years. We haven't had to worry about it as a kind of pernicious and consistent force in our investment decisions for almost 40 years now. And that has changed the way a lot of people have thought about it. And because they haven't experienced it, they don't believe it's real. They don't believe it can be a problem because nothing in their experience reinforces the fact that it could be a problem. Yes, we've seen little spikes. If you look at the chart CPI, we've seen little spikes and it always got tamped down again. We haven't seen that second wave of inflation, which is where I think we probably are between the foothills of the first and the second, and the fact that the Fed are cutting rates is probably going to exacerbate that at some point if they continue to do it. But again, as people have talked about, and as Stan Druckenmiller pointed out in a recent interview, they're in this position where they kind of have to cut rates. The economy's doing okay, but they're worried about being able to fund things with higher rates. So there's this, the walls are closing in. So for us as investors, you talk about the framework you have to look through. I think it starts with understanding the change that inflation makes, both to the investment environment, but probably more importantly to the mindset of investors, because there are some terrific books on this that you can read. The Dying of Money by Jens Parsons with 2 S's, or 3 S's if you count one at the S, which you can certainly get a PDF online. And then When Money Dies by Adam Ferguson, again out of print, but you can get a PDF online. And these talk about past periods of inflation, and they drop you right in to these times. And when you read about how people reacted to inflation, the things they did, the decisions they made, it will give you a much better understanding of what is likely to happen again when inflation becomes a meaningful problem. Because the one thing that doesn't change is human nature. We will respond to the same threats in the same way. We'll respond to the same problems in the same way. And, technology sometimes offers us better solutions to certain problems. But the reality is the problem of inflation is not one that technology can really kind of dilute for us. We're forced to face that problem of inflation, which is rising prices, but more importantly, loss of purchasing power in time-honored ways. And so the thing I would recommend everybody to do is to do some reading about previous inflationary times, understand what happens, because the constraints that get put around policymakers are pretty consistent. They will all be forced to confront the same problems, and the solutions available to them are generally speaking the same. And so as soon as you understand how previous administrations, our previous central bankers have reacted to inflation, the sooner you recognize how people react to inflation, the better chance you have of, at least when it hits, even if you think the probability is 10%, that inflation is a problem, we're not going back to 0% rates, at least you have an idea of the things you need to do to mitigate that. And as long as you have an idea, at least it may not put you ahead of the people who are prepared for it, but it'll put you in front of the people who don't have an idea. And that's really, you get to this point where you're trying to scramble up the tree and be higher than the people below you. If inflation is going to bite people's ankles, you want to be as far up the tree as you can be. So that's really how I look at this, through an historical lens and through a lens of preservation rather than accumulation. And I think just that mind shift is important, but also very difficult for a lot of people to perform.
This episode is brought to you by Public.com. Public.com has just announced its new bond account, offering a 6.6% yield on your investment until 2028 when the first bond matures. Here's why it's interesting. Bond yields have been at their highest levels since 2009. However, the Fed just announced its first rate cut, and more are on the table. In fact, current estimates from the CME FedWatch suggest rates may fall as low as 3% by the end of 2025. The good news, investing in a diverse portfolio of corporate and high-yield bonds could lock in today's historically high yields, even if the Fed cuts rates. That's why Public.com created the bond account. It's a new way to invest in bonds and earn a 6.6% yield on your investment for the next 4 to 5 years. Go to public.com/Julia to learn how to lock in a historically high yield on your portfolio. The bond account, only at public.com/Julia. This is fantastic. Great. You're teaching us so much. So, all right, great book recommendations. I will link those for the folks watching and listening, or find the PDFs for them rather. Okay, can you give us a bit more color on what it does do for the investment environment typically, and kind of looking at history, what does it do for the mindset? Maybe based on everything you've kind of looked at or read over the years. What does that look like? How should we think about it?
Well, think about let's think about CPI. This is the best way I've found in the last couple of months to demonstrate this. The CPI is the number that the Fed are always having their feet held to the fire over. They're always talking about this 2% number. They're always talking about it's got above, it's got below our 2% level, and we need to do something about that. And so the chart that the Federal Reserve are looking at to combat inflation does this. It's a rate of change chart that fluctuates positively, negatively, and they're trying to get it as close to 2% as they possibly can, and that's fine. But the I in CPI stands for index, and so the CPI index, is an index, and it doesn't fluctuate; it just moves in a given direction. If you look at the CPI index, it just goes from the bottom left to the top right. The prices just keep getting higher, and of course they are, because what they're trying to do, the Federal Reserve, is increase prices by 2% a year. Which, if they can do that, the price is going to go up in a nice, even line, up 2% a year. And we, as the public, hope that our wages maintain pace with that line. But if you look at that CPI index, forget the rate of change, you just look at the index, you'll see that post-2020, there was a big spike in that as costs rose. And that spike has gone past a horizontal line on that index, where for a lot of people, which is the line of affordability. And I just mean their everyday lives. There's affordability. And when you're a long way below that horizontal line of affordability, you have this cushion which you can build up savings, and you can invest, and you can do all things with the surplus capital that you don't need to spend to live on. Once the index crosses that line of affordability, you don't have the ability to save anymore. You don't have surplus capital that you can reinvest into either savings or productive endeavors, or whatever it may be. You're now, as the phrase says, struggling to make ends meet. You're struggling to pay your healthcare and your rent and your heating and your food bills for your family. And once you cross that line, as you approach it from beneath, you're feeling the pinch. Things just feel more expensive to you because you realize that you've got less in your checking account at the end of the month. But you're constantly being told inflation's coming down, the economy's good, and you can listen to that. You want to believe that. We all want to believe positive things. We all want to believe in the good outcome. We all want to believe that everything's okay. That's just human nature. And so despite in your gut you feel that it's not right, and you feel that things are getting more expensive and trickier, you're being told by people behind podiums in suits and ties with seals on them that things are okay. As soon as you cross that line, as soon as you get past affordability, it doesn't matter what anybody tells you, because you literally cannot afford to put food on the table or put gas in the car or whatever it is. And so your mindset suddenly changes. It doesn't matter what anybody says, they're now lying to you, which they probably always were before, but you were willing to believe it because you just felt like, okay, things are going to be okay. Now, not only do you feel like you're being lied to, but now you're angry. Not only because you're being lied to, but because you can't afford the basic necessities that you feel you should be entitled to do, because you go out and you work hard and you save where you can. That's taken away from you. So this mindset shift is That's where populism is. The gap between the fitted line to the CPI and this spike that took us this far above the line. As I said in my presentation, in that blue space, I colored it blue, that's where populism lies. That's where Donald Trump lies. That's where social unrest lies. That's where all these things that we struggle to explain and just don't make an awful lot of sense because the world has been pretty linear and pretty understandable and pretty trouble-free for a long period of time. That's why all this stuff is happening, because suddenly the world is unaffordable. And once it becomes unaffordable on an individual level, this is when people start going to their political constituents' offices and knocking on the door and saying, hey, I need to talk to you because I can't afford my heating. And so it suddenly becomes a political issue because now these elected representatives in whatever country they're in have people knocking on the doors, complaining to them, telling them they need to fix this. You need to do something about this. So it becomes a political issue. And suddenly it becomes an issue that people need to campaign on because it's the only thing people want to talk about. I mean, I would think if you followed any candidates around for the election, I'm pretty confident that the number one thing, once you got past all the political antipathy and the energy around good guys and bad guys and our side and their side, the number one issue is going to be inflation. That's the thing that all these guys are being hauled over the coals about. Why can't I afford my healthcare? Why can't I afford this? Mm. So we're in that place. We're in that place where people are angry. They're no longer listening to the people telling them it's okay because they say, well, I now have proof that it isn't okay. Before I was trusting you that, I might be feeling like things are getting expensive, but maybe I need to pull my horns in or something. Mm-hmm. I now have proof that I can't afford things. So it shifts the mindset. It shifts the mindset towards one of anger, and it shifts the mindset towards one of, this is a problem I need to be able to solve, and I can't solve it, but you can. And if I vote for you, I want this problem solved because this is the single biggest problem facing me right now. It's not sending aid to Ukraine or Israel. It's not, picking a side for Hezbollah, Hamas versus Israel. None of that. This is about me as an American citizen or a UK citizen. And this is why you're starting to see a lot of people query all the aid that's being sent overseas because it was fine while everything was okay, but it isn't anymore.
Right.
So decisions that policymakers would have made instantly a year or two ago about how they deploy the tax receipts, and let's be clear about that, that's the only income they have is tax receipts. How they deploy those tax receipts, well, you have to deploy it servicing the debt, cost of that's gone up. You have to deploy it on entitlements, they're not going down. You have to employ it on the military now because the world is becoming a demonstrably more dangerous place. So the vice is getting squeezed on you more and more and more. So that's kind of where we find ourselves. The public want things done to solve a very personal grassroots problem that they are facing. They expect their elected representatives to take care of that for them. Mm-hmm. Those elected representatives are being told, hey, times are tight. We don't have a lot of cash to throw around. You need to go back and try and calm everybody down. So when you go back to people after all these years of largesse and all these years of seeing asset prices go up and all these years of seeing billionaires in the news being feted and being, having seemingly an outsized platform to spread their views, it was great when everybody felt they were getting rich. But when people feel like they can't afford to feed their families, suddenly, the Forbes billionaires list isn't aspirational anymore. It's like, I want what they've got. We need to take what they've got and give it to us because it's not fair. That's the place we're at now. Whether we like it or not, none of us wants to be here, but we're here. And so if you think about all the constraints that dynamic I've just outlined puts upon policymakers, you see where they are. They are going to be forced to placate people by making things more affordable. And their solution to that, unfortunately, is going to be to print more money, is going to be to offer more stimulus, is going to be forgive more student loans, is going to be to find ways of making groups of people who feel underserved and underprivileged feel better. There's no way to do it out of tax receipts because things are so tight. Yeah, go ahead, jump in. Sorry, I'm
this is fantastic.
You carry on.
You're great. You could talk all you want on this show. Okay, it's become the number one political issue, or it's one of their biggest problems. So they want politicians to do something about it. And as you point out rightly, I'm going back to the beginning of our conversation, our debt situation, the cost of servicing that debt, where to cut spending. They can't cut defense, entitlements. So they're going to have to go into greater debt, bigger deficits, monetization. Does that put us into more of this loop, though, where if you do that, and that impacts the currency, the debasement of the currency, and does that create more inflation if you go there?
Yeah, absolutely does.
So are we in just like kind of like a vicious cycle, doom loop? Like how? Well, let's unpack it a little bit further.
Well, look, it does. Ultimately, the simple answer is it does. Now, there are things that could mitigate that. A severe recession, right, and a commensurate rise in unemployment, a significant rise in unemployment tends to slow this train down because, it's fine to be demanding 15, 20% pay rises. But when you start seeing the unemployment numbers going up, you start seeing your neighbors get laid off from their jobs, people tend to get a little less shirty about wanting a 20% pay rise. I just want to keep my job. Recessions tend to slow down the inflation train because demand obviously shrinks, and that tends to have an effect on prices. Wars are great ways of dealing with inflation. They're terrific ways of dealing with inflation, and you can see this throughout history. Again, wars are a great way to bind a public to a common cause and get them to accept constraints around capital and constraints around returns on capital they ordinarily wouldn't necessarily accept. And you just have to look at post-World War II and the yield curve control that the financial repression that the US government put on bondholders, but between the late 40s into the 1950s. And that's the other thing. There is always good old financial repression. There is always good old, for the public good, we are going to force every pension fund to hold a minimum amount of US treasuries. And that way we can sell our treasuries without the yields going up because we can sell them at a capped rate. So the important thing is to understand the problems. Because once you understand the problems, there isn't just one solution. There are multiple ways it can play out. But once you understand the problems and you understand the constraints under which the people trying to solve the problems are operating, at least then you can think through the things that they may be forced to do in order to solve those problems. And they have to solve them. That's their job. They're there to solve these problems. And solving the problems right now is really making people feel a little bit better about the world. Yes, it's finding a peace solution in the Middle East. Yes, it's finding a peace solution in Ukraine. But you have to understand a lot of things that people talk about as conspiracy theories in terms of the people that want these wars to drag on. Whether we like it or not, whether we believe it or not, you can make a very solid case for the fact that the longer the war goes on in Russia and Ukraine, and the Russian war machine is being ground down in this long conflict, it kind of suits the West. It kind of suits the West to let that Russian machine be degraded by another country. And so if you think that that isn't part of the calculus amongst people making decisions, you're wrong. They're absolutely thinking that. Is it better for us to let this war drag on and hopefully degrade the Russian war machine to a point where we are preeminent, once again, indisputably? Or does it reach a point where, okay, this could spread now, we need to sort this thing out, we need to get around the table and finish it? That's a calculus that is being made, I promise you. It's not conspiracy theory. And a similar calculus is being made in the Middle East. So understanding the problems, which is too much debt, which is a problem of saving a currency. It's a question of placating the public who are now finding life unaffordable. It's a case of narrowing the wealth divide whilst maintaining power. You realize that there are only a few options open to them. And so do we get a burst of growth from somewhere? Possibly. That would help. Do they default? It's very, very unlikely. Is there some kind of wild discovery, cold fusion, whatever it may be, that massively reduces costs and brings down inflationary pressures? Possibly. But again, that's for all of us to handicap. If you think the odds of cold fusion are a coin toss that happens in the next 10 years, well, you have a much easier problem to solve. If you think cold fusion is a pipe dream, you've got a much bigger problem to solve. But the other stuff, the war stuff, the inflationary stuff, the political angst stuff, that's not magically going to go away. And the debt isn't magically going to disappear. A lot of people are looking to Japan to see how Japan have navigated their way through this. And that's a good idea and a bad idea, because Japan is fundamentally different to the US, to every other country in terms of its bond market, which has been the kind of key battleground to try and pull off this incredibly difficult landing. So, as I said, we keep coming back to this idea of confusion, which we started with. There are so many cross currents now. Pre-COVID, you could sit there and say, hey, globalization is a thing. The world's pretty peaceful. Prices are going to go up. Low rates are here for forever, certainly for the foreseeable future. It's okay to borrow. It's okay to spend. You could say that with some confidence. You can't say that anymore. And whilst you can't say with absolute certainty how this is going to go, in 2018, the number of potentially bad outcomes was small. In 2024, the number of potentially bad outcomes is very big. And because of that, and the damage that a bad outcome and a significant drawdown in your portfolio can have, means it's much more important to pay attention now and have a plan than it was in 2018.
Mm-hmm. You mentioned you are looking at it from the lens nowadays of preservation versus accumulation. So whatever you are willing and able to share, like how are you thinking about the preservation side of things, maybe from what you want in your portfolio, or if you could share like how you think about construction. I know it's different for everybody, but just would love to hear more there.
It is, and I for that exact reason, I very, very rarely talk about that, except in small groups of people where I know exactly what the audience is looking to do and why, and it's obviously very difficult on a platform like this. But I think that I've spoken about this a lot in the last year. In fact, the last 2 years, as this has kind of ratcheted up, I've spoken a lot about this, about what does it mean to build resiliency into your portfolio. And look, anyone that's seen me on here before or on any other show in the last 10 years has heard me talk about gold. And it wasn't from you need to own gold with 100% of your portfolio. It was gold is going to perform as you would expect it to in times like these. The price is going to increase, which is more reflection of the purchasing power of your fiat currency decreasing. And it's going to protect your purchasing power. And it continues to do that. There happened to be, in the last 2 years, since the Treasury froze the Russian central bank assets, there are more reasons to own gold now. And that's a big part of what I think you're seeing playing out now. It's not necessarily the purchasing power argument. It's the fact that people feel they need to own gold now. And once you need to do something, it becomes a very, very different dynamic. The short end of the Treasury curve is a sensible place to be right now. You can get a decent return on your assets. Is it going to protect you from inflation? Probably not 100%, but it will give you the kind of help you need in a period of great uncertainty to at least know that, if you can find, and I was talking to someone recently, I forget who it was, so if they're watching this, I apologize for not name checking you, but we were talking about literature going back hundreds of years. And if someone's done a study, if you go through literature, whenever they talk about finance, and Jane Austen springs to mind immediately, there's something magical about 5%. It's mentioned many, many times in classical literature that, a good man is earning 5% on his savings and all this sort of stuff. And there is a mental, there's something mental about earning 5%. That's enough for a lot of people. It's a fair return. And they're happy getting 5%. Even if inflation might be 6 or 7, people are willing to park their money at 5% because they look at what that means in absolute terms, and it's a meaningful return, and it's a return that they can live with. And so it does encourage people to be a little bit less irresponsible with their capital and chase higher yields a little bit less, even if there might be a small gap between the inflation number and their returns. So that's sensible. Private stuff, and I don't mean private credit funds. I mean lending money to businesses you understand, businesses, privately operated, not listed businesses. And again, this idea of finding places to invest your capital that's away from the stock market and away from three-letter acronyms, which will get pulled and pushed and thrown around in any kind of storm. We saw Tesla results come out yesterday and the stock go up 20-odd%, which is ludicrous. And if you were short Tesla going into the results, I wasn't. If you were short Tesla going into the results, which, were definitely not a plus 20% event, you've been carried out. So finding companies and people to invest in that aren't subject to revaluation of your capital minute to minute, hour to hour, day by day is an important thing for your peace of mind, to help you realize that, hey, I've invested this money in a business, not in a stock. And they used to mean the same thing. They mean completely different things now. People talk about which stocks you're investing. The right question is which companies you're investing in, which businesses you're investing in. That's what investing is all about. If you're buying a stock, you're speculating. So it really is taking a more long-term, more considered approach to where your capital goes and putting it in places that, A, provides you some kind of safety net. There's no absolute safety net, but short-end treasuries are about as safe as you can get. Investing it in businesses that you understand and that you know the management and you understand the plans and you can see them executing on those, tying up capital in a business, excuse me, that will do well in difficult times. And there are plenty of them. People think, oh my God, everything's going to go down. There are businesses that thrive in inflationary times. There are businesses that thrive that prioritize the customer, prioritize the business and not the stock price. So there are all kinds of things you can do. As a broad idea, you look at commodities. For inflationary times, commodities are incredibly cheap relative to stocks. And I suspect that they will become a lot more valuable. Does that come without volatility? Absolutely not. Absolutely not. So if you want to invest in commodities for the long term, I think we're in an inflationary cycle. I think as a long-term investment, commodities are a great idea. Could you see big drawdowns if you don't align your time horizon with your mentality and your risk tolerance? Absolutely. And that's where this investor versus speculator thing comes in. If you want to invest in commodities because you think this inflationary period is going to last for the next 5 years, then invest in commodities for 5 years. Don't look at them if they're down 10% in the day and say, oh, I need to get out. And that's difficult for people to do. If you have a 5-year idea, you have to give it time to play out. So there are all sorts of things you can do, but it's become a lot more difficult. The solutions are not as straightforward as they were. Just passive index funds is the way forward. That may not prove to be the case. I suspect strongly at some point it won't be. And the whole dynamic that Mike's laid out so well that works on the upside, this relentless buying, if that turns into relentless selling, we haven't seen what that looks like yet, but I guarantee it won't be pretty. So to me, it means becoming more thoughtful. It means not throwing money at a stock because your buddy said he's investing in it, which it felt okay to do for the longest time. It's about trying to build resilience into your portfolio. It's about being able to withstand shocks. It's about being willing to take less risk, but still take risk. It's as I said earlier, it's a completely different mindset. And the sooner you at least sit down and think about what it means and what it will require to be successful in an environment which is 180 degrees reversed from the one you've had for the last, I don't know how many years, at least take the time to think it through.
Yeah, it's a good point. Let me ask you this. The Federal Reserve's rate cuts in September and the reaction we've seen in the bond market, the 10-year. What does that signal? Does that signal to you that maybe the rate cuts were a mistake? Maybe inflation hasn't been beaten like they might have thought? Just curious.
Yeah,
what do you think?
I mean, all of the above, but I think more importantly, what it signals to me is that the bond market is no longer willing to just play the game. They're no longer willing to follow the Fed when they cut rates just because it doesn't really matter what the economy is. It doesn't matter about the reality. We've been in a period where the reality was set by the Federal Reserve's interest rate moves and their forward guidance. That set the reality for people, and the bond market was happy to play along. They could hold their nose and they could buy bonds because they knew the direction of travel. Now they're being told to do the same, and the reality is more important to them now than it is following the Fed. Because if you followed the Fed, you made money. The Fed dictated the market. The Fed had control of the market. When they said this is where rates were going, that's where they went. And so whether you believe they were right or not, it didn't really matter. And if you're a bond market investor, you're like, well, the Fed's going to cut rates. We're going to go with them. Now, clearly, that jawboning, that forward guidance, whatever the Fed's been talking about, how the world is, the fact that it confronts the reality that bond investors are seeing actually matters to them now. And so now they're saying, well, you know what? Maybe we don't follow the Fed. Maybe they're cutting rates for all the wrong reasons. And just following them is going to be problematic for us. So no, we're not going to just blindly follow the Fed lower. We're going to demand higher returns on our capital. We're going to demand greater safety. We're going to demand greater cushions, greater spreads. And that's what I think is happening. And when the bond market does that, there's all this talk about the bond vigilantes who we haven't really seen for multiple decades. And have they disappeared? Have they gone away? Are they ever coming back? Doesn't really matter. They're not. It's not a union. You're not going to suddenly see them picketing the Mariner Eccles building. But little signs like the one you just described, that's a sign that the bond vigilantes, whatever form they take this time around, are coming back, because they're not just simply doing what the Fed wants them to do. They're actually taking a long, hard, pragmatic look at the numbers and the possible outcomes and voting accordingly. And that should be a red flag to a lot of people.
Yeah. Okay. What is it? Okay. What does that mean? Like the bond vigilantes, it should be a red flag. We've heard this term used over and over, but maybe the implications there, is that also a sign of it's a sign of the loss of trust as well? Like, I want to just hear a bit more because,
again, our mutual friend, the magnificent Jim Grant, has this terrific saying that he's coined many, many years ago, where he said, the price of gold is the inverse of trust in the central banks.
Interesting.
And I think he's absolutely right.
Huh.
And so that is ultimately what I think is happening here. It's a breakdown in trust. And we've seen that breakdown in trust at a political level. That's writ large. We've all seen that. We've seen it on a societal level. We've seen neighbors not trusting neighbors. We've seen families not trusting families, ostensibly because of politics. But it spreads. That trust, that lack of trust spreads. The foundation of the word credit is credere, Latin for to believe. This is all an act of faith, everything. And so when trust goes, and again, it's funny, the last 2 years that the presentation I put together this year was called Who Are You?, which is talking about this investor speculator dynamic. Last year's was the evaporation of choice and trust, and how important it was that if we see those things evaporate, what it means. And in the 18 months since I put that presentation together, that's exactly what's happened. We've seen this trust disappear. And so when you see it on a human level, neighbor to neighbor, and all the stuff we get bombarded with on social media of people fighting over this and that, and it's horrendous to see. But of course, it then permeates through every strata of society, and we get to the financial system where trust is absolutely critical. Without trust, there isn't a financial system. And that's why we get these periodic episodes where we have these resets and we have this complete loss of trust in not just the actors within the system, but the system itself from time to time. That's what we saw in 1971. Again, we haven't seen it for 50 odd years. So people think it doesn't happen. They think it's a pie in the sky idea that the financial system itself could reset. And yet in 2008, we saw the justification of the TARP as, well, we need to do this to save the system. No one really ever quantified what that meant. But what it really meant to me was trust in the system. We need to make sure that the trust that the system won't fail is maintained. And if the trust in the system not failing needs to be transferred to trust in the central banks to prop it up, that's what we'll have to do. And that's what they did. So the trust in the system became trust in central banks. Now, clearly, trust in central banks is starting to wane. And trust is an amazing thing. It takes forever to build up. It disappears like that. If you suddenly believe you can't trust someone, nothing they say is immediately going to change your mind. The trust can be regained, but it takes time and it takes effort, and it takes demonstrating that that trust is not misplaced. So that's where we are. I think we're at the beginning of that. And the concern is always when it begins, how quickly it disappears. And trust in the financial system disappears quicker than most things because the outcome of being wrong and misplacing your trust in anyone in the financial system is a loss of capital, which for anybody investing is absolutely unforgivable. So yes, it's a very long way of saying yes, but the question was absolutely the right one. Does this mean we're starting to see a loss of trust? And I think we are.
Yeah. And I suppose, Grant, you and I have both interviewed Neil Howe. This is like emblematic of the fourth turning and that loss of trust in the institutions.
Yeah, and Neil's right. I mean, people can read Neil's work and say, hooey, but I think Neil provides enough historical parallels to absolutely confirm that this isn't bunkum. Is it infallible? We don't know. We can't go back far enough to know it's infallible. But everything we're seeing now fits into Neil's fourth turning framework almost perfectly. The only troubling thing is it probably, if you look at the framework, it probably means we've got another 5 years of this. Mm-hmm. And of course, the fourth turning is a climactic event. So what we're feeling now is a step on the way to the climactic event. It's going to get worse. The emotions are going to get stronger. The tears in the fabric are going to get bigger. And we have to be prepared for that. And look, being prepared for it and it not happening, terrific. That's a phenomenal outcome. Deciding you don't need to prepare for it and it happening anyway is a catastrophic outcome. So, I think it's incumbent upon all of us who are managing either our own savings or those of other people to take the time to think this all through and think about what a truly different world might look like and the challenges it might pose to us.
Mm-hmm. You've shared an incredible framework and thesis and the different probabilities that could play out. I imagine you're also someone that you put yourself on the grills. You challenge your ideas and your thinking. Putting yourself in that position right now, is there anything that you see that could alter your thesis or change it or maybe even put us back on the right course even?
Well, there's always cold fusion. There's always politicians becoming fiscally prudent. There are always things. And the one thing I think everybody needs to do, and I certainly do, is my mind is completely open to being changed. I am not wedded to this as the absolute outcome. There is always a chance that something could happen. And I don't know what it is, because ultimately this is a challenge of mathematics, and mathematics are absolute. The numbers ultimately can't be fudged. You can fudge gap reports, you can fudge balance sheets, but when we get to the period we're in now with the debt and the income of the Federal Reserve, it's actually pretty simple, right? They have one source of income and a million sources of outgoings, and they have to try and balance those. It's pretty simple. So mathematics is undefeated. But I would never be so hubristic as to think, well, this is absolutely what's going to happen. This is absolutely the outcome, and there's no other potential possibility. I mean, that's the road to ruin right there. Mm-hmm. So I'm constantly searching for things. I'm doing a lot of thinking around AI now. Is AI potentially some part of some solution? I don't know, but I'm open to the possibility it might be in some way, shape, or form. And if anybody says to me, "Hey, have you thought about this?" I will always take the time to think it through. And if it presents a scenario that I think violates the one I already have, I'll be absolutely willing to change my mind. I won't be stuck to anything. The only thing I've been really stuck to has been gold. It's the only thing that really I've been a buyer of and specifically not a seller of for 20 odd years. 2003, 21 years. So
wait, what was gold back then? Sorry, in 2000.
No, I did, but I bought it for very specific reasons because I looked.
Totally. No, I was just wondering what did gold go for even back then? I'm like
$333 an ounce was the first price I paid for a gold coin. And so that's the one thing that I've stuck with. I've been in and out of all kinds of things in that time. But the reason for that was because I felt over the next 10, 20 years, who knows, debasement was going to be the solution to a lot of the problems facing central banks post 2000, the dot-com meltdown and the response to that. So that's an example of having a long-term idea of how the world is going to go and having a plan for it. I didn't put all my money in gold. I've just accumulated gold as a means to protect that portion of my purchasing power over that period. And I don't see any reason to not continue doing that. But at some point, and I've spoken about this often, I never think about selling the gold. I always think about exchanging it for something I want more. And so at some point, the way things are going, a certain amount of gold that today would buy you, a Mercedes, that same amount of gold in 2 years might buy you a Rolls Royce. And maybe I want the Rolls Royce more than the gold. I don't know. I doubt it. I don't think I'll ever drive a Rolls Royce. But my point being, the gold will maintain your purchasing power and in periods of stress will actually increase your purchasing power. And that's the problem I saw as a long-term one that I had to mitigate. And so gold was the solution to me to that. And it's done very, very well. But I'm absolutely not someone who says I will never sell my gold. I will absolutely let go of it at some point in exchange for something I want to own more. So that's the kind of long-term thinking that I think is important. And then as you go through that long time horizon and in the middle you see these ebbs and flows, they're the times you have to make smaller on-the-ground adjustments for things that don't fit into that long-term thesis.
Yeah. If I don't ask you this, I know there are going to be comments in the comment section. Do you have gold, obviously, but do you have a point of view on silver?
I do. Yeah, I do. Look, I think silver is also a monetary metal, and I think that's important. I think people wonder about platinum and palladium. They're not monetary metals ultimately, and silver has a history of being a monetary metal, but it's also an incredibly important industrial metal. And so, for me, owning gold was designed to protect my purchasing power with the least amount of volatility that I could generate. I think over time, silver will perform the same function, but it will be much more volatile. And anyone that's followed silver knows this to be true. Gold will kind of do this, silver will do this. It might end up ahead of gold, and there'll be periods of time where it outperforms gold significantly because it's so volatile and so speculative. But for me, this wasn't a trade. It wasn't something I was looking to time. I wasn't looking to try and pick silver. And there were times early where I would have alongside the gold I was just accumulating, I would switch trading money between gold and silver and try and get those ratios. It's very stressful, and you get it wrong, you feel like an idiot. So I think we're in a period now where silver will probably start to outperform gold potentially quite significantly. But it comes with the caveat of being an awful lot more volatile than gold. And so if your reason for buying it is you think it's levered gold, you buy into the idea of gold, but you want the extra juice. I've become accustomed to, 10 baggers and I want the 10 bagger. Go with God, but just realize that it's a much more volatile ride. And unless you're smart with it, silver's not a buy and hold unless it's over the very, very long term, put it that way. It's an incredibly volatile asset. So I wish anybody that wants to trade silver the very best of luck.
Got it. Well, I'm glad you were able to share because I do know if I don't ask, it will come up.
Grant, absolutely, as it should.
I love having you on the show. I do want to get you on more often because, gosh, I could listen to you for hours, truly. And I feel like there's so much we could go into.
Well, I'm sorry you've had to. I'm sorry you've had to listen to me.
No, we love it. We love it on this channel. I'm telling you, this crowd, they will love it. I want to give you the final few moments here. Obviously, let folks know about where they can find your work. I know you're quite present on social, but things that make you go, your podcast, and any parting thoughts. Take as much time as you need, and the floor is all yours, Grant.
All right, let's get the easy bit out of the way first. Grant-Williams.com. You can find everything on there. It's all in one place, so that's nice and easy. And on Twitter, I'm at TTMYGH, which is the acronym for things that make you go hum. So parting thoughts. I guess. Really just to kind of wrap up and consolidate what we've been talking about for the last hour, Julia. And I commend you for having these sorts of conversations because they're so important. And we live in a world where what a lot of people think they want and think they need is a stock tip. Is to be told which stock to buy that's definitely going to go up, so they can make some easy money. And that's kind of worked for a period of time. And we've had this kind of sweet spot, which never feels like a sweet spot when you're in it. It just feels like reality. It only feels like a sweet spot when you look back on it and wish we were there again. And we'll get there again, but not until we've been through a wholly different and much more difficult environment to navigate. So, you know, don't look to the past, the immediate past, to determine the future. Look much further back than that. Read history, go back those 2 books, The Dying of Money and When Money Dies. Easy to remember because the titles are so similar. And if Julia links them in the bottom, they're PDFs, download them on the internet. They won't take you long to read, and they will, if you know nothing about these times and what happened back then, they will absolutely blow your mind. And if you know a little bit about them, they will bring it to life in a way that will be incredibly helpful to you in determining what might happen from here and the threats that you might face in terms of trying to protect the capital that you've worked so hard to accumulate. So that's really the parting words I would say. Just understand that the world has changed, understand what kind of world it is, which is an inflationary one, and try and find out through historical accounts what happens during these times, because they're very, very different.
Grant Williams, author of the Things That Make You Go, newsletter and host of the Grant Williams podcast. An absolute honor to have you back on the show. Thank you so much for being so generous with your time, your knowledge, all of your wisdom. Really appreciate you. And let's not wait a year until we have you on again. Thank you so much, Grant.
You're very welcome. You know where to find me, Julia. Don't be a stranger.
I won't.